Underneath the headline top-line beat at NetEase lies a sharp divergence in operational health versus non-operating drag. Led by Chief Executive Officer William Ding, the Chinese tech giant relies on its massive online gaming division as its core cash engine, supplemented by learning platform Youdao and cloud music. For the second quarter of 2026, total revenue grew 7.9% to 30.1 billion renminbi, beating consensus estimates. Operational profitability expanded rapidly, sending gross margin surging to 70.4%. Yet non-GAAP earnings per American depositary share landed at 12.02 renminbi, missing the 15.54 renminbi estimate. That bottom-line shortfall was driven by heavy investment losses and elevated operating expenses, overshadowing a remarkably robust underlying gaming pipeline. Breaking down the numbers, total revenue reached 30.1 billion renminbi, equivalent to roughly $4.4 billion. The earnings hit came strictly below the operating line, where investment portfolio markdowns and higher operating costs dragged non-GAAP earnings per ADS down to 12.02 renminbi. Meanwhile, core operational profitability surged, as overall gross profit jumped 17.5% to 21.2 billion renminbi, lifting gross margin to 70.4% from 64.7% a year ago. The primary revenue engine remained games and value-added services, which rose 9.7% to 25.0 billion renminbi. Domestic hits like Where Winds Meet and Sword of Justice, paired with the global expansion of Marvel Rivals, drove gaming gross margin to an impressive 76.1%, bolstered by reduced platform revenue sharing costs. Outside gaming, Youdao generated 1.5 billion renminbi, up 3.5%, while deploying its Confucius large language model. Cloud music delivered stable top-line performance at approximately 2.0 billion renminbi. NetEase continues to direct this cash flow toward shareholders, declaring a quarterly dividend of $0.096 per share and executing roughly $2.3 billion in share buybacks, while deploying artificial intelligence, tools for art generation, non-player character interaction, and automated code testing. Analyst commentary focused heavily on product execution, international expansion, and operational efficiency. Alicia Yap from Citigroup opened the call asking about early player feedback and future optimizations for recent open-world launches. Management acknowledged receiving critical user feedback regarding steep early learning curves and unpolished onboarding during initial open-world releases. To fix this, the team is streamlining initial game content while leveraging a deep pipeline of high-quality updates to improve long-term player sentiment and community retention. Zuking Zhang from CICC followed up by asking how the upcoming urban open-world title, Ananta, plans to differentiate itself against aggressive genre competition. Management stated that Ananta remains on track with a major reveal slated for Gamescom, asserting that its unique thematic identity, novel narrative, and balanced monetization will allow it to stand apart from competitors. Lincoln Kong from Goldman Sachs pressed management on driving future business growth, given a lean release pipeline and a high revenue baseline. Executive leadership reiterated an uncompromising focus on premium quality, noting that artificial intelligence capabilities serve as a development amplifier to accelerate production schedules, enhance user experience, and deliver more high-margin titles than industry peers. Richie Sun from HSBC inquired about the commercial release timing and monetization strategy for testing titles Beneath the Mist and Thomas Shadowvale. Management responded that both games are undergoing intensive refinement, maintaining that launch dates will strictly depend on reaching top-tier player satisfaction metrics rather than artificial financial deadlines. NetEase is executing a fundamental structural shift. By converting self-developed premium intellectual property into an international cash machine, the company is insulating its core business. Lower platform fees, aggressive AI integration, and steady global expansion are cementing high-certainty operational margins that outweigh short-term investment volatility.